basically index funds have existed since the 70s.
Yeah.
The dominant trend since the 70s has been declining real interest rates and now reversing. American supremacy. Like there's so many things that I could point to go, well, maybe that narrative is changing.
Yeah, maybe the narrative's changing. But I think that what I would say is, why would you expect it to change? Like what is it? So people say, oh,
it's just my luck.
It's an increasing market or it's a declining market.
Yeah.
Like if it's a bull market, then of course index funds will beat active funds. But in a bear market, when the market's falling, then the active funds will beat the index funds. Why? Why is that? I don't understand why that would be. I've never had anybody clearly explain to me. I mean, I totally understand why index funds do well. And in a way, it's kind of obvious. I mean, they just are. If you average up all the active funds, then that's the index. That is the market, right? So of course, on average, it's going to do as well as the active funds on average, and their fees are lower. So after fees, it's going to do better. So that logic seems really, really strong. But I haven't seen a really strong logic. I've just seen a lot of special pleading as to why that should change, and I would accept that maybe there's a situation where the stock market's not the right place to invest, and maybe you should go into a bond index fund, or you should go to a commodities index fund, or maybe you should be investing in property. I could understand that's a logic that's not really what I do, but I could understand that might be the right thing to do.
Periods of outperformance for other asset classes.
Yeah.
So you're timing like asset classes.
I can see how that might be.
We might get a period where gold does better than the stock market.
Yeah, exactly. And well, you do sometimes get a period where gold does better. But what I don't see is the fundamental thing of like, if you're investing in stocks, then I don't see why you would ever not want to choose an index fund.
Because of the fees
actives.
are certain, and you get that gain instantly. But the active will say that indexes have distorted the market to the point where, because of market capitalization weighted indexes, you're just pouring your money into the big seven, and they're now 25% of the total index. So what you're actually doing is you're just buying companies that are overvalued, whereas what we do is we will find opportunities within it that are fairly valued. And,
well, they haven't done it yet.
No. I mean, I'm not that. I'm like anti-active. I'm just trying to throw the arguments.
Yeah,
at you.
I mean, there's a couple of ways to sort of interpret what that argument that you've just relayed. So one is it's a bad investment to get into index funds. Because they're too concentrated. Maybe that's true. If you're worried about that, there are kind of equal weight index funds. So you can basically say, do you want to hit the button?
No. We are very familiar with.
I can hit the button.
You want to hit the button?
So the idea is, say it's the S&P 500, so the top 500 companies in the United States. An equal weight fund would just say, right, well, $500, $1 in each of those companies, whereas a more traditional index fund would say, well, NVIDIA's a really valuable company, so we put more of your $500 in NVIDIA and in Apple and in Google and so on, in the big ones. I mean, I'm not hugely convinced, but there's a separate argument that says, in the end, even though it's a good idea as an investor, it's a bad idea for the world, for everyone to be in passive investing.
Capital properly.
And that argument, I think, has got some merit, although I would say it's not my problem to set prices in the market. Yeah. But I think at the moment it's about 50-50. So about half the money in the market, I think, I could be out of date.
This is of funds, right?
Yeah. It's about half. I think half the money.
51% is passive and it's tipped. But there's a lot of people that still hold individual companies. So there's probably a much bigger component of active. So if you call active anyone who picks a stock.
Yeah. So the question is, at what point do you have so many people who are just saying, I just want to buy the market, and so few people who are actually picking stocks that there's no information in the market anymore? So the fear is, if you imagine Joe Stiglitz, Nobel Prize-winning economist, once wrote a paper about this. If you imagine a situation where literally nobody picks stocks, everybody just goes, I just want to buy the market. At that point, there's no reason to believe that any of the prices of any of these companies are fair. And if you actually came along and did a bit of fundamental analysis and said, actually, what are the profits of these companies looking like? What are the growth prospects? Which is the best deal? You get fantastic bargains. So if you were in that situation where literally nobody was a stock picker, you could make a killing being a stock picker.
The opportunity swings the other way.
Yeah.
Exactly.
So the question is, we're at 50-50, as you say, ish. does that create opportunities for the stock pickers? I suspect not. This is just an instinct based on economic theory, not based on any data. I think, I don't know, 10% of people, 5% of people, you don't need that many, because 5% of investors is still a lot of money. You only need a few people setting the price, doing the stock picking, and everyone else can go, you know what, you guys are so clever, you do it, and I'll
You have
just buy the index.
95% passive.
I'm speculating, but the point is and when you go into Tesco or Sainsbury's, the prices of those products reflect the cost of the product, and they reflect the competition from other stores. So I go into Tesco, did I check what the price was in Sainsbury's? Did I check what the Asda price was? Did I check what the price was in M&S? Generally, no, just go into Tesco. It's fine. There are some people who are checking. Like I wrote a column once about the idea of their grandmother who's in front of you in the checkout queue, and you're like, I can't believe this woman is taking so long to pay for her groceries, and she's got all these vouchers and all. But be thankful to her, because she's the one.
She's the active investor.
She's the active investor. She's keeping them honest. And as long as you've got a few people who are actually really, really keenly comparing the prices, then you don't need to bother. And the same basic thing, I think, applies in the stock market. You need some, you don't need everyone.
I love the fact that you knew what the equal weighting was. It was like a proud moment.
I've come a long way, buddy. I've come a long way.
Yes, mate. Don't need the buzzer. I want to talk about, because I think the active guys, my theory on this, is it's not well thought out, but I think what's actually happened is index funds have just allowed people to participate in the market where they're not getting ripped off. Yeah. Whereas before it was through a broker who was charging you a fee, and basically a lot of the return that's generated is just the saving in fees, like you pointed out. And we now have a position where I can explain to people on my YouTube channel who would never have invested the simplicity of these broad indexes, and they'll participate, and that can only be a good thing. And I think traditional finance is just bitching because they're like, we should be getting 2% of that, and we're not. Any day now it's going to turn, and the 1 year that active beats passive, they're all going to be like, look, even though the record is 50-0.
There was a lot of money to be made convincing people
Cathy Wood
to pay fees.
Did great out of it,
But when there's a lot of money to be made convincing you to pay fees, I'm like, maybe you shouldn't be taking these guys too seriously.
That was a clip from our full-length conversation with economist Tim Harford. If you want to check out the full thing, you can watch it right here.